What's up, you guys? It's your girl Alexandria B with Wall Street Been Black, and today I want to do a crash course on indicators for you guys. So the ones that we're going to go through today will be the moving averages, MACD, RSI, Keltner Channel, Bollinger Bands, VWAP, pivot points, volume, because that is an indicator, and a whole lot more, right? So first things first, what we're looking at is XLI, which is the S&P's version of the industrial sector. All right. I absolutely love it. So we're going to go with volume first. Volume is the first indicator we want to look at. First off, until this time, right, until we crossed above here, this was the highest point. We'll just say about 142 was the highest lows that the industrial sector has had. And this was in November. I'm on the weekly time frame right now. All right. Please note that when price did pop up and make a new high, that the volume decreased. This didn't match. Price action alone was telling you, because I was a spinning top at new highs, right, on the weekly. That alone told you right there. But the fact that the volume also decreased with it. Volume is the most powerful indicator that you have to use. I know some don't, they have different ways of reading volume, but as long as you got your finger on the pulse of where, if the trading is buying or selling, you good to go. This lets you know that the buyer stepped out, a retracement was coming. That's step one. All right. Now, the next indicator that I want to pull up for you all is going to be the moving averages. Now, moving average is going to be this pretty little line that you can pull up on your chart, and it's simply telling you what the average price is for whatever number that you input in there. So the one that I just turned on, this line that we see here, is the 9 moving average. Now, I want you to keep in mind that it's depending what time frame I'm on, that 9 moving average is going to be in a different place every time frame. Now, let's explain these MAs, moving averages first. It is literally, and only telling you what the average price is. That's it. Right now, this is telling me, and I put the value at 9. This is telling me that the average price for the last 9 weeks, is $139.08. That's the average price. So I use the analogy, think about when we're in school. If you are testing above your average, they move you up with your peers. If you're testing below your average, they move you down with your peers. So when you see price cross above a moving average, I don't care if you have the 257,000 day moving average pulled up. I truly don't care. If price crossed above that level, it's bullish. Yay. You testing above your peers. You need to move up a grade. You're going up. If it closes below, let me make sure I say close, right? We love to see a candle close for confirmation, all right? If it goes below it, you can go back to the third grade. It's okay. It's okay. You'll get back down there with your peers. You'll learn what you need to learn. You'll get some steady footing, right? You'll find some support, pun intended, and you'll move back up to where you're supposed to be, all right? That is all the moving average is doing. Now, there are the 9 moving average. There are 5 moving averages that are most used. You're going to see people pull up just different numbers and all of this, whereas I have the 9 pulled up right now. Some people will use the 8, some people will use the 10. I'm going to tell you to do your due diligence as far as which one do you like the most. Because it really don't matter. You're going to get to the point where these things don't matter. So we see when the 9 moving average for the weekly, when I have the 9 pulled up, it's at 139.08. If I drop this down to the 8 moving average, which some people will use, we see it's 139.54. If we go up to the 10, we see that average moving down, right? Because it's accounting for more days. And we can definitely see in the last 21 trading days, because this is 3 weeks, right? Or 15 trading days, that price has dropped. So we should expect the higher the average goes, the lower that moving average should be. It just makes sense. Now, don't let that go over your head, child, because the point is, they all sitting up here on this yellow, on this dotted line. All right. Mhm. So do your due diligence and decide which one you like, which one makes the most sense for you. Now, other than the 9 moving average, which I don't even want to talk about time frames yet. The other four that are the most typically used is going to be your 20-day, your 20 moving average, your 50 moving average, 100 and 200. Now, I want to talk about those four time frames specifically. I said the 20. You will very much so often hear other people say the 21 or the 26. Again, do your due diligence. The only one that I was able to really dive in and figure out exactly why is the 26-day moving average used is it goes back to the Japanese when they first were doing rice trading. They only traded 26 days out of the year. So the whole strategy, like with the moving averages, it was built off the 26 days, right? Yeah, it got adjusted along the way, years and years and decades later and whatnot. Again, do your due diligence. There's not that much difference between the 20 and the 26. It's just going to be whatever you learned, whatever you focused on and got comfortable with, stick with it. Right? Now, so when we're talking the 20s moving average, let's break down how many days can we trade in a week. We can trade up to 5 days in a week. There's typically, in the perfect month, 4 weeks in the year. So that 20 moving average is showing you that average price for the last month. The 50-day moving average, or I'm going to say the 50 moving average, is showing you what the average price is for the quarter, right? 50 trading days is about 3 months of trading. That's a quarter. The 100-day, that's right at about 6 months of trading that you're able to do. Because we have a little over, 220 trading days? So don't quote me on that. Don't quote me exact on that. So that 100 is it's about half a year's of the average price. Whereas the 200, that is your average annual price. All right. So when you have those numbers, or when you have that understanding in your head of the time frame of these moving averages as well, that should help click as to which average do you pay attention to on what time frame. So when I'm on this higher time frame, right now I'm on the weekly. When it crosses below the 20s moving average, whatever it is, I'm like, okay, you cross below the monthly price. I should think that the drop should only last a couple of weeks, under a month, right? That's it. That's the only average you lost was the 20. Now you get in there and you start losing the 50. I'm thinking I might hold this swing trade for a month or so. You losing that 100 and the 200, the market is shifting. All right. We're going from bullish to bearish on the market or on that stock, whatever. Now, that does not negate the fact that the 9 moving average is going to be very powerful here on this weekly time frame. Not at all. This was my indication of, oh, you can get in and trade this down to the nearest support level. I'm not expecting, because it's only the 9 moving average, I'm not expecting to see this drop for weeks and weeks and weeks and hundreds and, well, not on in this case, like 20s of dollars, tens of dollars, whatever, right? I don't have that expectation because you only lost the 9-day moving average on the weekly. I'm expecting for you to drop, but I need to anticipate the closest support level, which here on this chart, we have it around the 136 range, right? I would have firmly exited there. Now, what I'm going to pull up now, because I'm a cheapo, all right? I'm a little frugal in some places. And for some reason, I don't know, when I first started using TradingView, the premium package was $30. Now it's 60. So I got the plus package, right? So because of that, you can't use an unlimited amount of indicators. So I like to use the moving average ribbon. And I'll show y'all here is simply just the moving average ribbon. This one will pull up 4 different moving averages for you. All right. Now I color code mine because I need to know what it is I'm looking at. I don't like to leave them the same colors. I like mine to be across the board. Now, by default, it will have the 20, 50, 100, and 200 put up. But when you click on the settings box, you're able to go in here and change it to what you want it to be, right? And you can also, if you don't want to look at them all, you can unclick it, have them all pull up, have them not all pull up, et cetera, et cetera. I actually will look at all 4 of them because I understand the relevancy, right? Now this yellow is my 20-day moving average, or my 20 moving average. Let me stop saying that. We're on the weekly time frame. So this is showing me what the average price is for the last 20 weeks, which is about 135. Look at the confluence. That's right there. Look at that confluence. You had a beautiful range of what you could pay attention to in here. I'm going to turn off the 50 through the 200 averages, and we're going to look at just the 9 to the 21. You had a beautiful range right there. And because I'm on the weekly, I know that this is a swing trade, but you knew when to enter below 139 and you knew what to target, 135. And it matches up with the trend line as well. Beautiful trade setup right there. All right. Now, why should you just automatically be out of there once it does hit that level? One, because you analyze and you set the trade up right. Two, because it hasn't lost the monthly price. This is still bullish. It's still bullish. You haven't lost the monthly price. You know, you could fail a couple tests, losing, or yeah, fail a couple tests, which is losing that non-moving average, but you must pass that year, right? You got, or that semester, to even think about staying in the grade that you're in and to pass on to the next one. Each semester must be passed. So that's how I look at that 20 moving average in there. The trend has not changed if it's holding the 20. And the fact that the 20 is in line with my trend line, my support trend line, which is holding and making higher lows for since, let's see, since October 2023, right? So for a year, over a year, it's been holding this. It's exactly what I should expect to happen. I should expect, right, for history to repeat and for it to come to the 135 level and hold there and move back up. Now, something that I want to point out is indicators is the fourth step that I use. I'm going to look at my resources, the highs and the lows, et cetera, first. Now, and I definitely check out seasonality because I like to make sure I'm on the right side of history, pun intended, right? So here, this is showing me the seasonality of the sectors. And so the light blue line, I hate that they're kind of the same, is showing me the industrial sector. This purple one here is SPY. So we come to the or pull the line back up for the industrial sector, and we can see that on the third and the fourth, right? The industrial sector the performance crossed below SPY. It dropped. Typically, in December, it is a bearish month in the industrial sector. We come on back up here and we check those dates out. Well, that's some confluence in there. Just another layer that lets me know that the indicators are in alignment with what price is actually doing, that we're going to see a drop. Now, I'm going to turn off the non-moving average and let's turn the 50 through the 200 back on. I also want to talk about the direction of these averages. They're turned up. The momentum is flowing up, baby. This is bullish. This is a bullish setup. If I was to see, for instance, you see how the non-moving average started to turn down here. Again, it's small steps to a giant because we're on the weekly time frame. That was a great indication again of, okay, I can catch this move from the 139 to the 150. It's absolutely beautiful. So let's look at another time frame with these 4 averages still pulled up, and we're going to go to the 4-hour. And let's start talking about crossovers. When not just when price crosses above an average, but when these moving averages actually cross above and below each other. Now, when the lower time frame, so I'm going to say when the 9 crosses above the 20, think about this. You have a 9-year-old who's out testing a 20-year-old. What they're going to do, they're going to move that 9-year-old up to college, right? That's bullish. When the short-term moving average crosses above the long-term moving average, that is bullish. When the shorter-term moving average crosses below the longer term, when that 9-year-old is like, yeah, I can't do physics up here with you, right? What do? They say, take your butt back to the 3rd grade. That's bearish. Very simple. I hope that made sense to y'all. Let me know in the comments below if it didn't. I'll put up another video very much so explaining it. But all right. So actually what we're going to do is turn off. We're just going to keep up the 20 and then turn the 9 back on. Let's look at price in relation to that. Even if you kept just the 20 moving average up, you found physics. Price is moving down. It also rejected from the supply zone. We got a double top here at the supply zone, which was step 2. It was high above the trend line. Step. Anyways, I will definitely teach y'all the 4 for 4. Trust me. But this was a 4 for 4 setup. So go ahead and enter in here when it crossed below the 141. Now I'm going to turn on the 9 moving average. Price crossed below the 9 moving average up here at the 143.50. That was hey. That was a really great indication, especially if you was already looking up top and you see that, hey, this is double topping at all-time highs. Chances are you about to work your way back down here, right? To see that could have provided an early entry for you to enter when it closed below this 9 moving average on the highish time frame, the 4 hour. And again, this is if you were already looking for this setup. Now you're just looking for your entry. But when you see this, when the 9th grader or the 9-year-old tested below the 20-year-old, oh, that was game time, baby. This was time for you to enter. You got a bearish crossover. It was time for you to enter. And again, we already had our target in mind. We had a target in mind, right? Now I'm going to turn on the 50, which is going to be the blue, right? And as well as with the 9. Now you got the 9-year-old and the 20-year-old trading going below the 50-year-old. You're very bullish. I mean, very bearish in this case, right? The more crossovers that you see, the more that you can believe in that, because everything is telling you that it's trading below average. Trade that sucker down. Any pop-up you see until it closes above the 9 moving average, it's simply telling you to keep shorting it back down. That's how you want to use these, all right? Let's go to travel down to the 1 hour. Now, here on the 1 hour, on a lower time frame, right? These lower moving averages are going to mean a lot more. So I'm going to go back to the 4 hour, and we can see that the 20 crossed below the 50, gave us a bearish crossover when price was at 141 on the 4 hour. On the 1 hour, the 20 crossed the 50 at 142.90. On the 15-minute, maybe you did it way up here at 143, right? So the lower yes, it is, the lower the time frame and the lower the moving average, yeah, it's going to be much more relevant, meaning it's going to help you to enter in sooner if you already have an analysis from up top. All right. If you do not trade on these lower time frames, it's simple, babes. Wait for it to cross below the average on the higher time frame. It is what it is. It is what it is. There's no right or wrong answer. You do not have to go down to that lower time frame. If it confuses you, you just got to be patient and wait on the signal to come up top. Now, when you get that signal from up top, it is going to show you longevity in the trade, that you'd be able to hold it for longer. It's confirmed once you start getting all these crossovers up top. I want to point out on the daily, the 20 and the 50 have not crossed. We don't have a bearish crossover there. Yeah, the 9 crossed below, but we don't. The 20 has not crossed below the 50 on the daily. Yes, that momentum's still pretty gosh darn bullish. Now I want to go to the 5-minute time frame, and let's look at how you can use the moving averages when you're ready to enter, whether it's a day trade and whatnot. Keep in mind, indicators don't work if you don't already have an indication, meaning an analysis, your stock charted without it looking like, never mind. It doesn't work, right? If you don't already have an indication of what price's intention is. This is your 4th and final step to confirm, and for you to kind of sit back and go, yeah, I analyzed a computer generated indicator, period. Per. That's how we use that, right? Now we pull up the moving averages. On the 5-minute, it's very much so that 9 moving average that I'm watching. It's very much so the 9 moving average, all right? So this was the opening candle of the day. And we know it opened here, pulled back, but then it came back above and in fact closed above the 9 moving average. The best thing that you can do is to wait for price to revisit it. You're going to hear me say that on everything. Wait for price to revisit it and confirm that it's going to hold it. Do I day trade XLI? It's not really a day trading stock. It's the spreads are wide. Do I swing trade it? Absolutely. But we'll just say in the perfect, whatever setup this is, right? This would be an entry. That'd be an entry. according to the average, right? Now, this price action signal down here, the tweezer bottom should have got you in a little bit sooner, but this was a confirmed move back to previous resistance, which this is previous resistance. If you look to the left of the cursor, you follow the cursor, right? It didn't make a big as a move or whatever, but the technicals still followed. It still followed through on there. And then when it came and closed back below the 9 moving average, if you were in calls, when this closed below the moving average, it's time for you to stop out. Don't get emotional. Retain some capital. Go ahead and get out. Price cross below average it's bearish. It's bearish. Right? And so those are our moving averages. I actually want to go back to the 4-hour because I saw something that absolutely fascinated me. I thought it was beautiful. Or was it the 1-hour? Let's turn the 100 and the 200 moving averages back on. Yeah, the 4-hour. Look at that 200 moving average right there on the trend line. That just gives me full confidence that price is about to hit the trend line. It's about to hit this 134. Do I want to trade this space from 136.38 to 134, knowing that the spread is usually wide on industrial sector? No. Do I want to have an alert set down there so that I know when you hit that? Because then I'm going to get into a swing trade back to 143. Yes, absolutely. So what can we do to be prepared so that we're not just sitting here watching it? So there's this really cool thing you can do. When you pull up the indicator box, you come on over here, you click these 3 dots, and then you say, I want to add an alert on the moving average ribbon. This will pop up for you. First thing I'll always do is let me know when a bar closes. All right. And I'm just going to go ahead and put cross. If I was expecting that this was going to lose this trend line, which I'm not, I would specifically say, let me know when a 4-hour candle has closed below and I'm going to specifically do the 200 moving average, which is the 4th one that's up, right? But for now, I'm going to keep it for crossing because it's going to let me know every time it touches it. So my alert is now set. And then I'm going to change the message on here. And I say, hit 4-hour 200 MA. And I know my shorthand, right? And the support trend line. And I'm going to wait on that alert to go off. Thank you. See you when you get there. Game plan is set. There's a lot of confluence here. This is the yearly average. And it's been holding this yearly average for the ding, ding, ding last year. History repeats. I should expect for it to do the same. So that is how you use and interpret moving averages. Now, here also I do the 100 moving average on the daily is also right here. That's even more confluence with no bearish crossovers above. Yes, the 9 cross below, but because for the last several days, short term, it's been trading down. It's been a loss. So I would expect that 9 moving average to have given us a bearish crossover. Nothing else has. The 20 to 50, nothing. You're flowing up. I feel good about it until I see a bearish crossover. I feel good about it. Or it loses the 100 in the trend line. Then guess what I'm going to trade it down to? I'm targeting the 200-day moving average. Right. So that is how we would use moving averages. Now, the next one that I want to pull up and show you guys is going to be the average true range. So this is beautiful. Let's say, hypothetically, I'm not Miss Cleo. I'm not saying that's what's going to happen. Let's say I'm looking at this and I say, okay, if XLI closes below the trend line, which the 100 moving average is also there, and it's a previous support level, so there's nothing but confluence here at 133.50, 134 on XLI. If it loses that, I'm targeting the 200 moving average below. So that is about a $6 drop from the 134 to 128. So average true range. It's in the name. It's letting me know what the average range of this stock is on whatever time frame I'm on, or ETF in this case. So on the daily, on average, from the highest point to the lowest point, XLI moves $1.38 on average. All right, on the daily for a daily candle. So I'd count that up. And I just round it down to $1 because I can't do math in my head that quick. And I'd say, okay, I'm expecting a $6 move. Every day you move about $1. So it should take 6 trading days for you to get there. You see where I'm going with this? This is helping me know what expiration date to choose. We still can't be Miss Cleo. Anything can happen, right? I don't know. Caterpillar could explode tomorrow, God forbid. And I mean, the thing just drop further than 128, right? But you can use this to give you a gauge. It gives you a great gauge. I very much so use this so that I know how the expiration date. So if I'm expecting that when it does, if it does, right, hypothetically lose 134, it take it about 6 days, and that's rounding down to get to my target of 128. I'm going to double the time for the expiration date, right? Because I already need at least 2 weeks because 6 trading days goes into 2 weeks. So I already need at least 2 weeks for the expiration date. But I'm going to add a little bit more time to it, and I'm going to go a 3-week expiration or a monthly, like 4 months away. I mean, what? 4 weeks away. All right. Because again, I'm seeing on average, how long does it take you to move down there? Right. And then you can also fact check it. We're looking for like that 128 or double check it. And so we go to the weekly and we say, okay, on average, how much do you move in a week? $3.78. This 133 down to the 126, from looking on the weekly time, kind of lining, or 128. I'm sorry, you're kind of lining up to me in there. That move could very much so happen. So boom, just based off that alone, without even going to the option chain, and we're just going to say that it was at 134 right now, hypothetically. Without even going to the option chain, you know what to get. And then we'll add the 128 put. And then if we're looking at expiration dates, it wouldn't be the 20th, wouldn't be the 27th. Yeah, the 3rd or the 10th, right? Now, fun facts. I'm going to go to bar chart and I'm going to pull that up and let's look at the 128. Let's just follow it through and see. When we go and we're looking at the option chain, and this is for XLI, let's see what strike price happens to have the most volume across the board. And we'll look at the put call ratio. And we'll start with January 3rd. Come on down to the puts. And this is not, right? Like, again, this is not the type of stock that you sit here and day trade. Beautiful for swings though, but this is not, it doesn't have a lot of volume to try to get in and out on the same day. But we're going to travel down to the puts. And we're looking at like this 128, no volume. So let me go to let's go back to put call ratio and look for okay, so the 117, the monthly, that has the most volume today across all expiration dates. So we'll go there. And I still want to look at the 128 strike price. And into the 130 and the 133. Hold on now. Everybody pause and write this down. XLI 133. That's an outlier. 133 put 117. That's something to watch. That's a lot of open interest. I mean, that's a lot of open interest. And positions were being held overnight in there. But we can see that this 128 is getting some love too. They're starting to open positions there. So to just go from chart to indicator to resource and to be able to look it through and say, bet, right? So that's how you can use average true range to your advantage. Next one that I want to look at is going to be, let's go moving average, MACD. It stands for moving average, convergence, and divergence. Remember, when something is converged, it's coming together. When it's diverged, it's going apart. So this one is at the bottom. MACD is specifically around to show us the momentum of price. The momentum. Is it speeding up? Is it slowing down? When it's speeding up, is it in positive territory or is it in negative territory? Because that means a lot, right? And so kind of think about when you get on that highway and you just coasting and then all of a sudden your phone go off letting you know that there's a speed a speed check ahead, which we all know that means that there's a cop ahead. Hit the brakes. All right. Once it's at nighttime, you might just get in there and do what you do because you know they're not gonna do nothing anyway. Y'all feel me? Probably a bad example, but y'all feel me? I hope so. All right, so let's talk about the anatomy of MACD first before we break it down. There's a couple of things we want to know. First, we want to know that these little bars here, it's called a histogram. Ciao. The bigger they get, the bigger they get, the more the momentum is growing, all right? And then when it changes into the lighter color from like this pink to light pink, this is showing you that the momentum is actually shifting, especially when it starts to decrease as well. All right. Now, it operates in really just two levels that you want to pay attention to. And it's going to be based off of this zero line that you see right here. Anything above there is in positive territory. Above zero is positive. Below the zero is negative. All right. Now, the lines here. This is two different moving averages, okay? The blue line is the difference between the 26-day, hey, and remember we talked about that a second ago, where that number 26 came from. It's the 26-day moving average minus whatever the average is of the 12-day, all right? It takes the 26 minus the 12, whatever that number is, it makes this MACD moving average in here, all right? So this is a moving average. The orange line is the signal, the momentum signal, all right? So when you see momentum cross above price, because I have to just let's go ahead and label these two lines. So it's not just like, oh, red, blue, what did he, I mean, what? So it's not orange, blue, what do these mean? What's it mean? Go ahead and label them. The blue line is the price, because it's the moving average. The orange line is the momentum, it's the signal. So when you see the momentum cross above the price and it's in bullish territory, it's in positive values, this was an indication to get in. So let's look at it on the chart. Well, look at that little price action signal. Let's even go here. We're in positive. I don't even know where to start. Look, we're in positive territory up here, and we see that the price crossed below momentum. We should expect for a sell-off. And again, the indicator is there to confirm what should already be on your chart. So to see that you got a bearish crossover, but price is still in positive territory, this was letting you know this should just be a pullback to the trend line. And then wait for price action to let you know that it's coming. Now, price action signaled it quicker. You got that hammer off the trend line. The indicator showed you here when it crossed over here. All right. A few days later that, hey, okay, bet, we bullish. Now, I want to add in, more than likely, the non-moving average will show us, period. That moving average is going to give you a quicker signal than MACD will. I like to use MACD for the total safety. That moving average, that's my go-to. And just let y'all know, because it's literally telling me what the average price is, and all we care about is the price. That's all we care about when we're trading and investing, babes, is the price. So all I care about is the moving average. However, now let's talk about the convergence and the divergence of it all. So we see that we got this bullish crossover while we're still here in this bullish or in positive territories. And we see that the lines, the price and the momentum, are diverged from each other. All right. We can expect that price is going to continue to move up. Once they start to diverge, we should expect that price is going to consolidate. Now, it's also the fact that price is sitting here consolidating in a range, but the indicator will also show you that. And you see it started to diverge a little bit. You got a little bit of a move up. Now here, price or the MACD was moving up when we're strictly looking at MACD, right? It's moving up. You get this bearish crossover. Again, this indicator is confirming what's already on your chart. I would have been targeting the trend line, right? But we also had a key level there. We also had our previous support level there and whatnot. And we see that's what it hit. Now, mind you, see how the selling momentum started to wean? It flipped in here as it was holding this demand level. There's a great indication to exit your puts. And from looking at price, it was bull flagging there at previous, again, The indicator is the last freaking thing you look at. All right. And again, right here, we got this bearish crossover right when oh snap. Hold on, I just saw some because I'm starting to see puts popping up everywhere. Okay, let's keep going. So we got this bearish crossover. Now, mind you, price actually went into negative territory. The momentum hasn't yet, but the price did from looking at the MACD lines only, right? I'm down here. We got a bearish crossover in positive territory, so we should be expecting for this to hit the trend line, right? To hit our support level. But notice how we haven't had price cross below since August into negative territory. And we got that little dip below the trend line here. Came right back above it, right? But this fascinates me actually. That the price and momentum is so diverged from each other and the price fell to negative territory. I see the momentum also crossing negative territory. I'm going to assume that the sellers are definitely stepping in. Plus, we're looking at the volume. That volume is higher. That's the number one indicator for sure, right? Yeah. So that's how we use MACD based off of the momentum. The next one that I want to show y'all, and they go hand in hand, is going to be RSI, which is the Relative Strength Index. All right. So let's break down the anatomy of RSI. So there's a couple of levels that you want to pay attention to. And I do suggest color coding your chart. You know what I'm saying? When you're starting off, if you do choose to use MACD. So there's three numbers that we pay attention to. One, I'll say that this ranges between, or it oscillates between 0 and 100. That is so important to remember because a lot of people will say that, I don't know, that this oscillates between 30 and 70. Not quite. We'll talk about that. Let me get this set up. And then the last one we're going to want to pay attention to is the 50. And this is the one that I'll kind of mark off white in here. All right. Now, this is showing you the strength of price changing, the strength behind price changing, like switching lanes. We'll say that. All right. Where the numbers come from with the 30 is anything below 30, not at 30, below 30 is telling you that this stock is extraordinarily oversold. It's been sold off to the lowest of the lows. It's about that time to exit your puts if you were in them or get ready to enter calls, right? Anything. We love that. We love that, especially for an investor. I want to throw that out there. If RSI is not near 30 or definitely below it, you should not be buying shares of that stock. And this is for the daily and upper, the daily and higher time frame. If RSI is all the way up here near overbought values at 70 and above, what the frick are you buying that share for? Wait on it to come on down a little bit. Might take a while, but it's okay. You're not going to miss anything. It's going to drop back to the same level so that you can repeat history and buy it again. Do not ever buy shares. Anyways. All right. Now, so yes, anything 70 above is overbought. It's been bought the frick up. It's been bought up. It's time for a drop. All right. Now, note, this is above 70. Above 70. And look at that strong pullback you had. Strong. And for XLI, this is very strong. I know y'all looking like it's only a $6 drop. It's XLI. You know, as we saw, it moves $1 a day from highest to lowest, right? This was a hey, get that money. Now, oh, let me point out the lines on here as well, the purple and the yellow. I ain't gonna hold y'all, I forget every time. So I open up the indicator box and I go to settings. And then when I'm looking at the style, I'm able to see, okay, yeah. The yellow line is the RSI moving average, which is the 14-day moving average by default. The way that you know that, it's right here in the inputs, it'll tell you. It's the 14-day simple moving average. And the purple is the actual speed behind price changing. So yellow is the price, purple is the gas pedal, right? So we see that we got off the gas pedal. Slow it on down. You got that drop, right? Now, the best thing to do, especially if you pulling up RSI and looking at it, is you want to take a trade off of these three levels, whether it's the 70, the 50, or the 30. All right. The most beautiful thing to do where you know for sure, because think about it, right? You're going to get at least a 50% trade. Just think about it. If you go from 50 to 70, or if you go from 50 to 30, you won't get at least 50% on that trade. I like the odds. I like the odds. I'm not the type who likes to catch the very bottom or the very top. I want to catch it off of a retracement level because I just have more confidence of where you're about to go to. Now, again, from looking at RSI and this, like price show is dropping. Show is dropping in there. Now let's look at what MACD pulled up alongside it. Which one gave us the signal first? Was it price double topping at previous all-time high? Yeah. Then next, the moving average told you what, 3 days later. And that aligned with the MACD. If y'all look down there, you got that bearish crossover. And overall, if we come back here, RSI let you know. RSI honestly let you know here that it wasn't going to go up. Now, why do I say that? Because it made lower highs. Oops, but same thing. It made lower highs. I don't like that. Let's do the different arrow. I made a lower high where if we stay in the same place, this made a higher high. Price on the chart made a higher high. RSI made a lower high as well as MACD. How do we interpret this? Well, babes, that leads me into talking to you all about divergence, RSI and MACD divergence. All right. This is simply saying that the price and the indicator are diverging away from each other, showing you two different things. And this is the only time where I'm going to tell you to follow the indicator first, especially and that's for MACD and RSI, because it's showing you the momentum and the speed behind price changing. So the fact that these made lower highs while price was instead pushing up, this was bearish divergence with MACD and bearish RSI divergence, letting you know those institutions actually do see that speed trap coming up. They just slowing down and then gonna let you go past and the cops gonna pull you over. And then while they got you pulled over, they gonna speed on past you, rubbernecking. All right. Follow the momentum of the markets. And that very much so works on lower time frames as well. Trust me. Trust me. We love it. We love to see it. Now, while I have this pulled up, I do want to go ahead and show y'all something that's just absolutely fascinating to me. Who is this Spy? What layout can I go to? I'm gonna go to the weekly, and I'm gonna clear all this off because I know how to chart. I can put it back, it won't hurt. First thing I want to point out is the divergence of these lines with MACD and RSI. I do not give a frick that price is moving up. Look at the momentum. First off, let's look at the volume. First off, let's look at the volume. We have lower volume since August. And if you one of my babes, don't ever forget that time NVIDIA reported earnings and I said meeting time now. That was in August. However, let us mark off what price is doing in here. We see price is making higher highs. Cool. We see the momentum is making lower highs. And I'm going to do it like this because I specifically want to point out, yes, I see it peeking up over there. As well as the speed. There's divergence in the market, y'all, up here on this higher time frame. I think we have an opportunity to get rich coming up. Body dip, body dip. All right, so that's MACD and RSI, which is going to show you the momentum and the speed behind price changing. And what I want to look at next is going to be Bollinger Bands. Bollinger Bands.